Hello, everybody, and welcome to episode number 32 of Confessions of a Market Maker. I'm your co-host, Ray, aka All Day Ray, aka Larry Zonka, and I'm joined here by my amicable co-host, former market maker of 20 years and present-day retail trader. Before the financial markets, he was a bouncer who was known as Choo Choo because he hit with the intensity of a train. He then went on to hit bids with the equal ferocity as a paper hanger on House Street. I'm talking about the Russell Peters look-alike, JJ. How's it going?
Good, Ray. How you doing?
I'm doing good, man. Doing good. Going a little stir crazy. Been a while in the house, but today our guest, he's had a legendary 52-year career as a market analyst. He is a founding member and a past president of the Market Technicians Association. He's the author of 4 books, and he's a man of timeless pieces of wisdom and wit. I'm talking about Walter Deemer. Walter, how's it going?
Just fine.
All right.
I'm still on the right side of the grass.
Oh, absolutely, Walter. Thank you for taking time out of your busy schedule over there at Addington. How's quarantine going?
It kind of sucks.
Mm-hmm.
Yeah. I haven't been out off the property since March 13th. So running to Publix is a thing of the past, and running to Walgreens is a thing of the past and stuff. Yeah. So it's like if anybody wants to drop off some ice cream, I'm here.
All right, my man. What flavor you like? What's your go-to flavor?
Probably just vanilla.
Just vanilla. Yeah. I like that. I like it. So I hear, Walter, in the in Addington, and the so for people that don't know, he's in a senior living facility, assisted living facility. I hear you like the goof.
Independent. I'm on the independent wing. I'm not assisted yet. Yeah.
Independent. Yeah. I hear you like to goof on the people there. You like to ask them opinions about the market without telling them your background. That's true.
No, actually, they like to tell me what their opinions are of the market, and they don't give a crap about what I think.
Sounds familiar.
I went out for a walk today, and some guy walks by me. He says, "Oh, 1931 market again, huh?" Okay, if you say so.
Man, so before we jump into your background,
he also assured me that the Globex, the opening price on Globex on Sunday night was set by South Koreans.
was set by South Koreans? Did he say why? Where does he come up with this?
No, he said that all the traders in South Korea set the opening price on Globex.
Really?
That's what he said.
I wonder if they know they're doing that. Maybe we should tell them.
We need to talk to this guy. We need to talk to this guy. Anyway,
I don't think so.
Anyway, before we jump into your background, go ahead.
Let me say this: if it does turn into a 1931 market, I'll give you his name.
Okay, good stuff.
What are your thoughts right now from an analyst's perspective? What's going on in the this interesting time in the market?
Interesting is the word. I personally don't see how anybody can have a lot of conviction on either side at this point over a short term framework. Mm-hmm. We're literally almost in uncharted waters, where markets caught between two titanic forces. One is the Fed printing like crazy, and the other is the economy crashing like crazy. And the market's trying to figure out who's going to win. And as it goes through day by day, I think and week by week, I think it's almost impossible. I'm in awe of traders who try to figure it out. The only thing I think I know is that 5 years from now, we'll look back and say this was a great long-term buying opportunity. But going through a great long-term buying opportunity day by day is kind of hellish.
Right.
Like for example, in late 2008 and early 2009, you look back on that and say, "Wow, that was a great buying opportunity." But grown men had nervous breakdowns while it was going on.
Exactly.
Mm-hmm. Yeah, I guess that's why probably JJ, right? A lot of people prefer day trading, right? In and out of positions real quick.
Well, yeah, for myself, I like to be able to sleep at night. And
Yeah.
with these ranges, how do you put a position together? Uh, so you gotta kind of let it shake out, I guess.
Walter, what type of stress does times like this put on an analyst in like his job duties? Because like if you
Uh,
go to a trader with what you just said, oh, like the intermediate to short term range, you don't know what's going on. Like, well, how does someone respond? Like, how would they respond to you?
I think like JJ did, he wants to go home flat.
Mm-hmm. Right.
He likes to sleep at night. I think that's enviable.
It's from the school of hard knocks, sir.
Yeah. Just looking at a day like today, the thing is up a zillion points and then down a zillion points. I mean, you had two intermediate term moves in 6.5 hours.
It's unbelievable.
Yeah. Today was eventful.
It was. This people keep. Are either of you doing the VWAP charts?
Some of the guys in my room, I'm a market profile guy. I'm one of the disciples of Dalton. So I just look at value and where price is being accepted. But
okay, so those TPO charts and things like that, which I don't know, they came out after I was educated, so I don't really understand. But did they help you a day like today?
Oh, so much, very much so. The market structure is. I never had the brains. I started off trying to go into being an analyst, and then I quickly discovered I didn't have the mental capacity. So hitting bids is it's a much less intellectually, you know, it doesn't take as much brains to hit bids and work out order flow as to put together a company report. So I went the trading route. But yeah, definitely I found market structure really, really helps me, in these times.
Because there are a couple guys on Twitter that post these things. I'm in awe of what they do and what they say, but I don't really understand what they're trying to tell me. So I just look at it and am in awe.
Well, I'm in awe of people who use technical analysis because I've never been able to wrap my head around it. I mean, I know it works, but I just haven't mastered it.
Well, TPOs are really technical analysis.
I guess so. In a way, it's
you're looking at price and volume. You're just looking at it a different way. But I mean, your price and volume are the two key things to technical analysis.
Right. Absolutely.
So you may not want to admit it publicly, but you're a technical analyst.
Oh, I know. I have a lot of respect for technical, analysis.
You are one. You said it.
Okay.
The legend spoke.
I'll take it.
Yeah. Yeah. 2 years ago, you couldn't even spell technician, and now you are one.
Exactly, and you don't know how true that is. Oh my goodness.
Oh, Walter, tell us about your background. What led you to becoming an analyst?
It's funny. Most kids follow baseball averages, and I, looked at another section of the paper, and I saw these other numbers, and my father says, that's dollars that their stocks in. So I was intrigued by the statistics. So I started following it, and I got involved. Went to the Pennsylvania State University and sort of worked my own curriculum because they didn't teach technical analysis, but there was one brokerage office in town, and 2 of the 3 brokers were involved in technical analysis, and one of them was an adjunct professor on campus. And this was right before the crash of 1962, which for those who read ancient history books, was a very emotional time. And I learned more in the boardroom of that brokerage house during that crash than I did on campus. And so I just got involved. And oh, by the way, that the crash in 1962 was one that was quite obvious from a technical standpoint, and I was impressed that they had seen it coming. And and I should add, one day I was riding back home to Philadelphia in the back of a car, and I had taken Joe Granville's book out of the library, and I read it, the Daily Strategy for Stock Market Profits or something. And I read it, and Granville is a very, very enthusiastic and persuasive writer, and he kind of hooked me on technical analysis.
Hmm.
And which is interesting because some of the other technicians of my era also got hooked by that very same book.
So how did you, when you went into the industry, I mean, you went in with the idea of wanting to be an analyst. What made you choose being an analyst over a trader? Like how does that process go?
Well, there weren't a lot of traders back then. It was mostly analysts, and I got a job at Merrill Lynch and went through their research training program. And a lot of people wanted to go work in the technical analysis department, which had all of 3 people in it. It was headed by Bob Farrell, and there was a guy working as assistant was a guy named Arch Crawford, who dabbles in astrology and admits it, unlike some other market analysts who dabble in astrology and won't admit it. And Arch kept saying he was going to quit, and Bob Farrell said, "That's nice, Arch. Now, what were the odd lots this morning?" And one day Arch came in and said, "I'm quitting, and this time I mean it." And Bob had 5 days to find a replacement, and I was the only person that had any background, so I got moved into the market analysis department over a couple of other people who had more seniority. So I started working in the technical analysis, market analysis department at Merrill Lynch in 1964.
Wow. So I mean, is there anyone on this planet who has more financial market experience than you?
Many people.
I mean, 52 years. Yeah, more than 52 years.
Yeah. 52 weeks on the floor of an exchange might give you more experience.
Okay.
Okay.
Yeah, definitely.
Just saying. I mean, when I look at the longer term thing and don't worry about the short term stuff. I can't figure that out at all. So I let you nice people try to figure that out and make money off it. I just look at the long term thing. As I say, I think looking back, you'll say, 5 years from now, this all represented a great buying opportunity. But living through this great buying opportunity day by day is hellish.
Yeah, I guess that's the big challenge, really.
Yeah.
Wow, that's interesting thinking of it that way. So, Walter, I always love to ask people with experience, because this is, a big topic. People always talk about it with algorithmic trading. From the perspective of an analyst, does that even change the way you analyze the market? Because I could see for a trader, the impacts, but from the analyst point of view.
From an analyst, it doesn't really bother me because I think when the market goes against people, they always blame the algos.
Right.
So if the market goes down and they're long, they blame the algos for selling. And if the market goes up and they're short, they blame the algos.
Right.
I think the market kind of does what it's going to do, and the algos may accentuate it. Remember, the algos, everybody's mad about high frequency traders clipping fractions of pennies out of every trade. In the old days, they used to have specialists. Specialists used to clip quarters and eighths and quarters and 3/8 out of every trade, and everybody said, "Well, that's the way the market works." So,
and
the liquidity now. Liquidity now. I mean, in the old days, you put in an order, and 10 minutes later, you'd find out whether you got to execute it or not.
Exactly.
So a fraction of a penny is a small price to pay for that.
Well, they never used to do business. They never used to do business for less than a kosher eighth, right?
Exactly. Well, we used to have a thing that I worked at the Manhattan Fund, which was part of the go-go years. The 3 Freds and a Jerry in the go-go years of the late 1960s. Three Freds: Fred Carr, Fred Alger, Fred Nates, and Jerry Sy, and they were the gunslingers. And that Jerry was very active in Burroughs, and the specialist in Burroughs was a firm called Marcus Schloss, and Erwin Schloss was the specialist. And we always used to tease that Erwin had hired an ex-linebacker from the New York Giants as his assistant. And when Erwin was working an order, if somebody came across the floor, the linebacker blocked him off until Erwin was done working the order, and then he let him through. And not as facetious as it might sound.
No, it was necessary part of business.
Yeah, but I mean, the specialists were universally considered bandits.
Oh, yeah. I mean, the first time I ever met a specialist was in 1995, and my partner asked him how he became a specialist. And the guy looked at him and he said, "If you have to ask, you'll never become one," turned on his heels and left.
I love it.
Oh, that was classic.
Yeah.
God, I love it.
Yeah, but I mean, the liquidity in the market now, it's incredible. The young,
Right.
the youngins just don't understand what old timers had to go through to try to do a trade.
Oh, yeah.
True. So just to clarify, no changes as far as like from an analyst point of view, behavior with the market, because I guess like as a trader, it has an impact on us, because I think certain elements, if you have a bot or an algorithm executing as opposed to a human, I think there would be some differences from that aspect, correct?
Probably, but how long does an algorithm take to execute?
I guess they got different. I mean, now I guess that's getting real in depth now. You know what I mean? Yeah. You have the short-term ones. I'm sure you have long-term ones.
Yeah,
But,
definitely.
but for example, I mean, today, I just look at today, and the market was up big on the opening and in the morning, and then it reversed and came down. I don't know whether algos made it run up in the morning. I don't know whether they made it come back down in the afternoon.
Right.
To me, it's just a plain old-fashioned one-day reversal.
Right. Yeah, that's why, like, I'm just talking this out loud. I'm just speculating. It probably affects more of like execution, right, JJ, from like a trader standpoint, not how we analyze the market on a macro view.
Yeah, for the longer term, these gentlemen are looking at 10, 20-year time frames.
Right.
And so we're the ones who have to battle the robots in the daytime frame.
Right. Because
battling the robots.
Yeah, absolutely. Right. No, because I know and maybe this is not an exact equivalent.
I see a Transformer movie coming up.
Because Walter, so I don't know if this is a proper equivalent, right? But I've played poker against bots, AI, etc., and it's way different than playing a human, right? Because a human, there's going to be emotions in his play. You might be upset he lost 5 hands in a row. It's going to affect how he plays, etc. So I'm thinking like maybe speculating like the same thing would happen with trading, right? Like as far as executing, like we all have times where we slip up, right, Jay? We get a little emotional.
Oh, definitely.
And maybe that changes the dynamics, but I'm not sure. I'm just talking this out loud, I guess.
Yeah, but I as we were talking before, that I think the best traders have no emotion at all.
Yeah.
It's impossible to do because all traders are human beings. I don't think, I haven't met you guys, so I don't know. You might be robots for all I know.
I only wish.
Well, I mean, the picture of JJ, I can't see his face. So I don't know whether it's a robot or for all I know, it's a patio umbrella.
This is probably a patio umbrella.
Patio. Yeah.
But what I'm saying is that the best traders or the best poker players are the ones that don't have any emotion. I mean, you respond to the cards, you respond to the market, you do what the market tells you to do. If you're wrong, you admit it and you move on. If you're right, you take it and you move on.
Absolutely.
The old saying, the market doesn't care what you paid for the stock.
Mm-hmm.
or position or whatever. I mean, the market doesn't care. The market's going to do whatever it's going to do, and you can't make it do otherwise. Absolutely. Unless you work at the Fed.
How did the Market Technicians Association come about?
3 guys got together at I think it was Massaletti's in New York. John Brooks, John Greeley, and Ralph Acampora. And they decided that they wanted to have some sort of technical group, and they decided they were going to have to get a few more people. And I think there were something like 19 of us at the beginning. There was a group from Boston for the institutional side: Bill Doan, at Fidelity, Bill Diani at Wellington, and me at Putnam. And the first big fight in the MTA was the original organization was the Market Technicians of Association of New York, and people in Boston got slighted because we were doing all the work because our organizations backed us. So Bill Doan did the newsletter, Bill Diani did the journal, and I ran the membership committee and applications and the bookings for the first seminar that we had. And so we said, why don't you make it the Market Technicians Association, period? And they finally decided that was a good idea.
Interesting. So you were the
and very few people know this, but in Canada, it's just the Market Technicians.
That's true.
Because then people go up and says, "Oh, are you a member? You're a member of the MT, eh?"
Eh?
good one.
Eh?
Good
Definitely.
one, Walter
So
with his
and
zingers.
anyway, but we started up and we had formal meetings. I think the most important thing the MTA did back before the MTA, the people had all sorts of their own proprietary indicators, and there was virtually no sharing of information. And the MTA opened it up, so now you have a great deal of sharing of information that's really unprecedented. And I think the MT, broke the logjam and said, "Hey, it's okay to share. I mean, you don't have to. You can share your techniques and things with other people, and maybe they can improve on it."
Now this is a hard certification. Is that the right word to obtain? I hear.
Yeah, it must be. I never did it.
Yeah, you never did it. You just a founded member. What do you mean?
Yeah, but I'm not a certified market technician or whatever they call themselves.
Okay. These are the ones we see with the CMT next to their name on Twitter.
Yeah, the CMT.
It's like a doctor or something. Yeah.
It's like a doctor or something. But the thing is that there was stuff in there, and I don't want to get into some of it, but some of the things you had to learn, I looked at and rejected early in my career, and I said, I don't want to learn this stuff to pass the exam if I don't think it's useful.
Right.
I don't want a slight Elliott wave, but I didn't want to learn Elliott wave. I think some people have a lot of fun with it, but I think it's wonderful in hindsight and not very good in foresight.
Yeah.
Well, it turned out some guy makes a presentation at one of their meetings, and he's doing a big Elliott wave thing, and he's got 10 minutes of why it's bullish. I said, "Oh, that's interesting." And he says, "Now, of course, there's this alternate count, which is bearish." And he goes in for another 10 minutes. I said, "Well, wait a minute. Which count are you going to do?" Now, in hindsight, you'll tell me which count worked. I want to know now.
Right.
So that's why I'm not certified. I'm not certified anything.
Okay. So I've had the pleasure of reading your latest book titled "When the Time Comes to Buy, You Won't Want to." So Walter, I'd like to pull some quotes from there. Have you elaborate a little bit on the ones that I picked out? Yeah.
Please.
Okay. All right.
And I might say that people, when the book came out a year ago, people thought the title was kind of strange. And in the last month or so, they understand it.
I think it makes sense now. All right. First one here. The stock market is a better economic forecaster than economists.
Yep.
Mm-hmm.
Because the stock market is a discounting mechanism. It's looking ahead. The stock market looks through the windshield, not the rearview mirror.
Mm-hmm.
And so it's always discounting things. And it happens to be the National Bureau of Economic Research has leading coincident lagging indicators. Stock market happens to be a leading indicator, economic indicator. So the stock market is a great thing to tell you what the economy is going to do, but the economy is not going to tell you what the stock market is going to do. It's going to. As a matter of fact, I wrote, when I was at Penn State, I wrote my honors thesis on technical indicators versus leading economic indicators. And the bottom line was the stock market was a great leading economic indicator, but it didn't lead the stock market, and technical indicators led the stock market.
Right. Absolutely. Yeah. When I first read it, Walter, I immediately thought of like sports betting markets, right? Because this is how I equate it, right? because people, always got people all the time. Oh, the Jets are going to do this year, or the Raiders are going to, and they're so strong conviction. And I'm like, okay, well, here's the line. You want to bet on it?
Yeah.
You know what I mean? Because the market's never wrong, or the market's wrong, but it's more right than not.
Yeah. Well,
And anytime there's big money involved.
Yeah, but it depends on if the line will move and things like that. Because I was I get involved in prediction markets, which is kind of interesting. The late lamented in trade was a great market, and that they had technical analysis of their markets, and it used to work really well. Unfortunately, the guy who ran it took $1 million out of the company without being supposed to, and the thing faded. And now there's something called predicted, which is not as good.
Yeah,
but
I know
but
predicted.
you can wager on elections and things like that. The problem is each market is limited to $850, so it makes it tough to operate in size. It also, unfortunately, makes the market not as accurate, because in the old days of the market, right, on in trade, the market got out of line, somebody come in with big money and put it back in the line.
Right, exactly.
Same way as sports bet.
Exactly.
If the Jets, if the Jets line is off, somebody will come in with enough money to push it in the right direction.
Exactly. But, efficient. Yeah, markets are more efficient than not usually.
Yeah, usually, but it depends. I mean, unfortunately with the Jets, even on a bye week, they're an underdog.
God, I know. As a Jets fan, it hurts. It hurts, Walter. But yeah, no, I really like that quote there. Okay, next one. All price changes are caused by an imbalance in supply and demand.
Yep.
Then that's just straightforward. Nothing else to say.
That's straightforward, because everybody wants to know a reason about why something happened, and some days and some days you don't know.
Mm-hmm.
But I think I put a quote out one time: "Ours is not to reason why, just correctly sell and buy."
Yeah, beautiful.
Jay, do you think this equates to kind of how we more or less, our style of trading? We like to trade inventory imbalances.
Definitely. I really agree with that. Like today, for example, we were trading the ES, the minis, and somebody yelled out that oil was just getting crushed, and I looked up and I saw oil just was falling apart like a cheap suit, and I said, "Uh-oh, margin calls," because and the S&P was ready to run the stops and go higher. But those margin calls came in, and they just started selling whatever was up, and the S&P was there. So those guys would rather sell something than wire money. So yeah, nobody. Well, Wall Street, we don't like to wire money. We like wires coming in, but we don't like to wire it out.
Yeah. Well, interesting. Also, stepping back a little bit, most climactic lows are accompanied by some sort of forced selling, as we saw back in March.
Definitely,
yeah.
And as you know probably better than I, when a hedge fund implodes, they sell what they can, not what they'd like to.
Exactly. And having been a part of a lot of clearing firm failures myself, I've kind of been there. So yeah.
And then there's another quote in the book from John Mendelsohn, who said, "Margin clerks are the most ruthless sellers Wall Street has ever known."
Oh my goodness, no kidding. They like, one of my favorite sayings is, "I never saw a bid I didn't like," and it goes double for them.
Yeah. and they don't care what you paid for it. All they want to do is get out.
Exactly.
Whether there's anything left for you or not, they could care less.
Oh yeah. It's ruthless. Mm-hmm.
Yeah, it is.
Yeah.
But, and that ruthless selling can create pretty interesting markets and pretty interesting snapbacks on the other side.
Very much so.
All right, next one here, Walter. I never look at a chart that doesn't have a relative strength line on it. This is RSI, correct?
No,
No?
this is actually relative strength.
Okay.
And the thing is, because having worked for institutional investors for many years, that they live by multiple sorts. That not only does a money manager have to have their accounts go up, they have to have their accounts go up more than the market, and they also have to have them go up more than the guy down the street's accounts go up.
Mm.
So that if the market rallies 12% and you're up only 8%, you're dead. So relative strength tells you where the leadership is. And one of the things that I was always doing is trying to find out where the leadership of what was going to outperform at the market. If this is the greatest, if this is really a great buying opportunity 5 years from now, what are we going to look back and say, what was the obvious thing we should have bought to participate in this?
Mm-hmm. Makes sense. All right, next one here. Always remember that we are dealing with probabilities and not certainties.
Yeah.
I love this one.
That's from the best analyst you never heard of, Stan Burge, who was an institutional technician. But people say the market's got to do this. No, it doesn't. It probably will do this. It very likely will do this, but there's no guarantee.
Right. Right. I mean, and isn't that such a, it makes me, it's so frustrating to me, Walter, talking to certain people, just in everyday life, people who are not involved in markets. A lot of everyday life people don't understand this concept. It's like, it's hard to tell them. Like, I'll be like, oh, well, I think this is going to happen 75%. Well, what do you mean 75? We don't deal in black and whites. Like I look at everything in probabilities. You know what I mean?
Yeah. Which is why God invented stop orders.
Yeah. Yep. Absolutely.
Oh gosh, that's beautiful.
You got the most perfect setup you've ever seen in your life, the one that works so well, and one of these days it blows up in your face.
Yeah, well, someone's got, one stray order can ruin your day.
Yeah.
Mm-hmm.
There are no 100% setups in the market.
That's true.
Right. You find 100% setup in the market, I'll guarantee. Whenever you think you find the key to the stock market, some son of a bitch will come along and change the lock.
That was one of the quotes in there, wasn't it?
Yeah,
I remember.
Well, it wasn't quite as salty as that.
But no, I think this one might have been my favorite one. I like this one a lot because I think it applies 100% to life as well. I think rarely in life are there certain things as well, but I think it would serve people better to think probabilistically. But all right, moving on. Next one. Markets and stocks can stay overbought for a long time if the advance is really strong.
Right. Old lesson. Markets get most oversold at the bottom, and they get most overbought at the beginning of an advance.
Right.
And this whole concept about breadth thrusts and things like that is the more powerful the advance in its earlier stages, the more powerful the advance overall. And if you Google breakaway momentum, this is something I came up with in 1973, which is a breadth thrust. Mm-hmm. And it's the unusually powerful momentum that you get only at the beginning of a really powerful move. It's only happened 21 times since the end of World War II. It's not something you're going to see a lot.
Okay.
But when you see it, you sit up and take notice. So it happened at the beginning of last year, January of 2019, and that when you get it, the market just goes up and it gets overbought, and then it stays overbought. It never gives you a chance to get in again.
Yeah, right.
Really, really, really good moves. Don't give you a chance to get in. If when the train leaves the station, it doesn't back up to let the latecomers off.
Right.
So
it's fascinating.
So when you see a move, I would suspect, even from a trading standpoint, if you see a move and it starts going your way, and then it backs up again to give people a second chance, it may not be that good a move.
Right. Interesting.
No second chances in this game.
Yeah. No, that's good stuff. That's good food for thought. That's
so The other thing, it's a corollary. The most bullish thing a market can do is go up and keep going up.
Right.
The most bullish thing the market can do is get overbought and stay overbought.
Yeah.
Because
that's crazy.
That's saying that the underlying trend is really strong. And I think the concept of the underlying trend is an important one, whether you're a short-term trader or anything like that. If you're trading during the day, what's how powerful is the underlying trend? Is it going to bias things to the upside or the downside? And what you're doing is you're trying to find out the strength of that underlying trend. The more powerful the underlying trend, the fewer counter trend moves you're going to have.
Right. Oh, good stuff. Yeah, that's So when it's most bullish or the most bullish thing a market can do is be overbought and stay so.
Yeah, and get really, really overbought.
Really? Yeah.
Mm-hmm.
Wow.
Because the most overbought markets happen at the beginning of a really big advance.
Yeah.
Oh, okay.
Yeah, it's interesting.
And then they stay overbought because they don't give the latecomers a chance to get on board.
Right. Okay. All right, next one. If everyone's waiting for a pullback to buy, either the market doesn't have a pullback, or if it does, you shouldn't buy into it.
Same concept. It doesn't give you a second chance. If everybody's waiting for a second chance to get on board the train, if the train backs up into the station to give you a second chance to get on board, something's going wrong.
Mm-hmm. Do you find where my mind went a little bit when reading this quote, like when the consensus, everyone thinks, or like you said, everyone's waiting for a pullback, like the quote says. Is that something to worry about when you feel like the consensus is saying something, or that's a kind of by case scenario?
No, I think the consensus is important, but it has to be an obvious consensus. Right now, half the people are yelling that everybody thinks the market's going to go back and test the low, and the other people are saying it's going to be a V bottom. There's no way it's going to come back. The consensus has to be obvious, or it doesn't count.
Okay, that makes sense. That makes sense.
Or one of the quotes in the book is, if you need an indicator to tell you whether sentiment's a factor, it ain't.
Right.
Right.
Right. Okay, that makes sense. Yeah, because I was thinking it's like we wouldn't want to just be contrarian because the consensus is saying this, but I hear what you're saying. That makes sense. Next quote.
It really is the deep-seated consensus. I mean, the consensus at the beginning of the year was the market was going up. Everybody was raising their price objectives. Tesla was going crazy. SpaceX or whatever it is, Virgin Galactic, whatever it was going. Everybody said, "Well, this is normal. This always happens in a market like this." And I said, "This is not normal. This is not a normal market." And the consensus at that time was the market was just everybody kept raising their objectives. I put out on Twitter. I put a link to an old Les Paul Mary Ford song, "How High the Moon," because everybody kept saying, I'll see your objective on Tesla and raise you 50 points."
Yeah.
Well, didn't work out so.
No, but it was it was a nice corner though. They ran a nice corner on it for a little while.
For a little while, but this is another quote. This is a Bob Farrell quote. That parabolic advances usually carry more than you think they will, that they don't correct by going sideways.
Right.
And a parabolic advance, I have to say, if you don't see it on a log chart, it ain't a parabolic advance. See, these arithmetic charts that go from 100 to 900 and show they don't count. It's the same thing with this virus thing. They're showing growth rates, and you have the thing starting off with 100 cases and then going to 5,000 cases, and they're using an arithmetic scale. It doesn't count.
Right. All right, next one here. I thought this is a funny one. I guess not much to be said here. There are no atheists in bear markets.
Yeah, when I worked at Putnam, that some fund managers didn't really believe in technical analysis, but when the market was going down, they would wander into the office and say, "What the hell is going on?" which is the other part of the book, when the time comes to buy, you won't want to, because they would wander in this literally happened. They would wander in my office and the market would be going down. And they say, oh, good, the market's going down. Is it time to buy yet? I said, no. So the next day the market goes down some more. They come in and says, is it time to buy yet? I said, no. And finally, to get rid of them, I told them, when the time comes to buy, you won't want to.
All right.
I'm not laughing. I'm serious. You tell me people who want to buy, after the market, when the market was down at the bottom in March, you tell me people who really wanted to buy.
You ever have any like funny, I don't know, debates or arguments with these traders when they would come to you like with what they want to do, but you're giving them, conflicting advice?
Yeah, but I kind of just, I said my thing. The problem was that a contrarian, the technical analysis, you're usually going against the consensus. So one of the problems in life was that I was going against the conventional wisdom most of the time, which is not a great career builder.
Yeah,
but,
sure.
Because it's like Dean LeBaron wrote in his book about investment people or something, and I was a technician. He says, telling the majority of the majority of your clients that they're probably wrong isn't a real good career builder.
I can see that. I mean, do you think that was part of your success? Was you were contrarian, I guess, to an extent?
Contrarian, yes, sir.
That's interesting because, I mean, it's not an easy game to beat, so if it's just something I thought, and that's why my mind went to that, to, the consensus when we read that last quote, because this is something I think on a lot too, right? Is like, because if this was so easy to beat, everyone would beat it, so I feel like you have to think a little different, no?
Absolutely.
Yeah.
Absolutely. That's why I'm not a trader. I don't have the emotional background, makeup to do it. So I know.
Yeah.
At least I learned I didn't.
Right. Okay.
Some people can, some people can't.
All right. Next one. I like this one right here.
And the other about the consensus is if you want to watch CNBC like the pros do, turn the sound off.
Oh, I was going to read that one. That's a good one. I like that one. Yeah.
Actually, I had that because the thing is, you see these trading floors, these trading rooms, and you see every one of them has CNBC on. I was in a whole bunch of trading rooms when I visited clients, and they all had CNBC on the television, but none of them had the sound on.
Yep.
They're looking for facts, but they don't want opinions. Or opinions are a dime a dozen and useless.
Exactly.
So you turn, and so I had a sign at a presentation I did at one of the MTA things for people that when they got on CNBC, that there was a big sign for them to hold up that says "Turn the sound up." and John Bollinger caught me after the meeting and says, "I want that sign." I said, "Okay, you can have it. I'm done with it." No, I don't know whether he ever used it, but he wanted it.
Oh, jeez.
Turn the sound up.
Oh, that's good. That's good. Yeah, I was going to ask you that one. That's good. All right. The stock market. Go ahead. Well, you got one more thing?
No, go ahead.
All right. The stock market will do whatever it has to do to embarrass the greatest number of people to the greatest extent possible.
Right. This is my law of perversity. It takes contrary opinion one step further. Yeah. Not only is it going to do what most people don't think it's going to do, but it's going to do it to embarrass you.
It's incredible how true that is.
Unfortunately, yeah.
It is. It is true, and this is why this whole game is just a whole mental. It's a whole mental mind game. It's man. Yeah. All right. Moving on. I could go down that rabbit hole. Yeah. When I like this one a lot too, right here, Walt, because this is 100% true. When a trader starts to feel really smart, he or she is headed for a huge drawdown.
Yeah. Isn't that the truth?
Mm-hmm. Oh yeah. If you're not humble, the markets will humble you.
Yeah.
Quickly.
Yeah. And when you think, like I said, when whenever you think you found the key to the market, some son of a bitch comes along and changes the lock.
Mhm.
Whenever you figure you've really got this thing now, you've had 7 really good winning trades in a row. You say, man, I finally got this sucker licked. Boom.
Mhm. Mhm. Yeah. Well, that's those. I don't want to ruin the whole book for people, but I really enjoyed the little quotes as it did. I mean, it did at least got me to step back and like I'll be reading, then I'll have to step back and think a little bit. Like, okay, yeah, so good stuff. So listeners, definitely go check that out. A lot more good stuff in there. So you wrote 3 other books, Walter, correct?
Yeah, the first one was Deemer on technical analysis, which was sort of the main treatise. And then I did one called The Basic Essentials of Technical Analysis, which was an offshoot of the Facts of Life lecture I used to give to the new analysts at Putnam. They all came out of the Harvard Business School, and they were all like little peas in a pod. They knew a lot about a lot of stuff, but they didn't know anything about the real world. So I had to tell them about the real world, and that the fact that for example, a stock is not the same as a company. And so you tell me everything. You tell me everything. That Tesla is going to do over the next 5 years, and you can't tell me whether the stock is going to go up or down.
Mm-hmm. Right.
And every one of the books has my favorite chart of all time, which is the McDonald's Corporation in the 1970s, which was part of the Nifty 50 growth stocks.
Mm-hmm.
And the earnings went up 25% per year, compounded all during that time, and the stock went down. Went from 25% growth rate, never missed a quarter. The stock went from 75 times earnings to 7.5 times earnings.
Wow.
Mm-hmm.
And guess what?
Your firm sold the bottom, right?
Yeah. Putnam bought the top and sold the bottom.
Yeah.
Huh.
Right. When you were advocating that this was the time to buy.
Yeah.
Right.
But,
you had the email or the memo saved, right? It was in the book.
That's one I saved. That's one that I treasured against her.
Yeah.
It's one of my treasured things because it worked out. Well, that was right before I was on Wall Street Week, and I wanted to mention some growth stocks on Wall Street Week because I knew the subject was going to come up, and I couldn't get clearance to mention McDonald's because they were selling it.
Oh, yeah.
So I couldn't get it. So I said, "The hell with it! I'll write a memo." And I said, "If that's not a major buy signal, I don't know what is."
Right.
Wow. That's amazing. Sorry, Ray, I'm interrupting here.
Go ahead.
Yeah, I just thinking, looking back at that time, the Nifty 50, and so you were with Jerry Tsai at Manhattan, and he was like one of the first people to, sort of momentum trade and trade large blocks, and with in a fast time frame and that sort of thing. And then he also raised like $247 million back in that time, which was
back when that was a lot of money. Yeah.
Oh my goodness, yeah, that's a lot of money in the 60s. What was he like? What was it like in that environment?
Oh, he was rather amazing. I mean, he was a real gunslinger, and that he was unique. The second guy at the shop was a guy named Bob Edwards, who was a better money manager, a better investor than Jerry was, but that's neither here or there. And Bob used to hang out in the boardroom, which is where my office was, in our war room, and watch the tape. And one day he picks up the phone and calls the trading desk, and he says, "It looks like there's a block of burros that's going to hit the tape. I want to buy 50,000 shares on a cleanup." And the trader said, "Well, you're right. There is a block of burros that's going to come out on the tape, but you can't buy it because it's Jerry's block."
Oh, jeez.
he puts the phone down and looks at me and says, "What's he know that I don't know?"
Oh, that's something. That must have been something.
That was the old day. In the old days, Fidelity. He came out of Fidelity, and Fidelity had the wild money managers, and that I was a contrary opinion for him in 1966. I was just young and everything. Mr. Johnson of Fidelity was the one of the speakers. And Jerry wrote me a note of introduction to take up. So I go up afterwards. There's a crowd around them, and I'm listening. And that somebody asked Mr. Johnson. He said, "How do you run Fidelity with all the different money managers? How do they work together?" Mr. Johnson said something. He said, "We run Fidelity as close to a complete state of anarchy as possible." Now, that is not true today.
Oh,
But back then, that you could have one person buying and one person selling, and nobody would care.
That's amazing to think of it, because it's such, it's a flagship of the industry now, and it's so,
Right.
what they used to call white shoe, and you would never even imagine it being run that way.
Yeah, it was, and now it's gone the opposite. I was told some years ago, and that I assume it's still true today, that money managers can't go deviate 2% off the index in a sector.
I've heard things like that, and then a lot of those decisions, those investment decisions, are made by committee almost, isn't it? Or yeah.
Yes, and in all the public parks and all the land, you will never see a statue to a committee.
Exactly. Definitely. Now, and back in that time, like, you were around, like, there were some very interesting things going on in that time. I'm a huge history buff on the street, and people like Charlie Bluthorn, with Michigan Bumper and Gulf and Western, and that. Did you cover companies like that? Were you?
Well, we owned them. One day that Charlie Bluthorn came in to see Jerry, and he said, Gulf and Western, and he said, "Jerry," he said, that I'm about to make 3 acquisitions that are going to knock your socks off. He said each one of the 3 companies is a component of the Dow Jones Industrials. So by the time that people came back from lunch, every fund in the shop had 5% position in Gulf and Western.
Wow.
And one of the guys had an income thing. He said, "Why couldn't he at least bought the convertible preferred so I got some income out of it?" And that was, if you look back at the chart of Gulf and Western, that was about 2 points from the top.
Oh, wow.
He did make 3 acquisitions, but you never heard of the 3 companies. They were all pretty small.
So was he as crazy as people said he was? I mean, that's completely before my time, but he was one of those mythical figures,
Probably. I didn't know him personally, but
Okay.
I would say that, coming in and telling Jerry he was going to buy 3 components of the Dow Jones Industrials is not normal.
And then he ended up making the movie The Godfather with Robert Evans. So, pretty amazing. The other thing is, you were around the time when Xerox was happening. Did you have any clue that they were developing what they were developing in Palo Alto with the Park Research Center? Were you guys privy to that? Was that?
No,
Oh, okay.
we had no privy or anything like that.
Oh, okay. Because I always thought, if you guys had gone and picked that apart, there were like 10 public companies that you could have taken public out of that place easily.
Yeah. But see, we didn't do that. We invested when they did.
Yes. Yeah.
We didn't do that.
No, just I always that whole Xerox Park story fascinates me. So I was just wondering if you do that, and just so the folks at home know, I'm a huge fan of Wall Street Week. I used to watch that in the 80s when I was a kid, and I didn't even know what I was watching. I just knew I had to watch it. So it's an honor having you on the show, because Rookheiser, and then of course Marty Zwig is every trader's hero. So the penthouse at the Pierre sort of thing, and you tell us a Marty Zwig story if you.
Well, Marty was on Wall Street. He was a panelist the night I was on, which was February 29th of 1980, which is the only time the program was ever broadcast, on February 29th. So I always had it in the back of my mind that the next time it was broadcast on February 29th was going to be 2008. And I thought I would let them know that if they wanted to keep the tradition of having the same guest on February 29th, they might want to give me a call. But the Wall Street Week didn't last that long, so that never happened. But he was the panelist, and he knew. He probably knew more about technical analysis than just about anybody. His book is probably one of the best that's ever been written on technical analysis.
That's amazing. And quick question, and you worked at the time when investment banks were partnerships. Goldman was a partnership, and do you think that now that these large banks are public companies, and now that you don't have partners with their own skin in the game, that the risk that they're taking is out of control with, leverage and that sort of thing? Is that something that concerns you at all?
Yeah, and they're taking risks that normal people wouldn't take, and that they try to put in controls after the market falls apart, like in 2008, and then they spent 10 years trying to go around the circumvent the controls, so it happens all over again.
Mm-hmm. Yeah, I mean, I think because when you had 30 old guys running the place and they had their money at stake, there was no monkey business,
Yeah.
And now it's not their money, as you say. They don't have skin in the game, so they do whatever they want. They take risks that normal people would have never even dreamed of taking. Back in the day.
Yeah. Okay, great.
And like everything, when they start taking risks, it ends up getting overdone, and that they go too far, and then it backfires on them, and something blows up.
Mm. And do you think that, like that nifty 50 time when valuations were stretched, do you think that's sort of similar to what we just went through?
Sort of a little bit with the FANG stocks, yeah.
Mm-hmm.
There were only 5 or 6 stocks instead of 50, but what the hell?
Yeah.
Mm-hmm.
It's interesting too, and I noticed that it's interesting to get your take on it, because when you were active, they had so many firms, and I come from the market making side of things, and we used to have a thing called the NASDAQ Red Book, which was a directory of all the market makers, and it was thick. It was like a Bible. Now it'd probably be like a 2-page brochure. It's become so centralized, and then you have money managers with trillions of dollars that have locked up the floats of Apple and Microsoft, where less than 1% of the float trades on a daily basis in these massive companies, which to me, as a guy who constructed markets to sell stock into, doesn't look very liquid to me. So I'm just wondering if that's something that you've noticed or have any concerns about, or any thoughts about that?
Concerns, yeah. Thoughts, no.
Okay.
I share your concerns, but I don't know how it's going to play out.
Yeah.
Except as with always, it won't end well.
Yeah.
I don't know how it's going to blow up in people's faces, but it ultimately will.
Yeah, I just look at the concentrations of stock that really just does not trade, and it's and the average daily volumes of these things are nowhere near as big as there's less than 1% of the float, so it's interesting.
Yeah, interesting. That's a good word. We live, as the Chinese would say, we live in interesting times.
Very much so. Very much so. All right, Ray, I'll pass it back.
Yeah, I mean, that's pretty much it for me. Walt, I guess just one more thing. When you were working as an analyst, were you cognizant of trying to keep a balanced life, or were you consumed by the markets?
Most market students are really more consumed by the markets than they should be, and I was probably one of them. Because the thing is, everything affects the market. So you turn on the news and they tell you something about this virus thing. You say, "Oh, I wonder how the market's going to react to that." Or you look at something like that and you say, "Oh, they're not going to play baseball for 2 months. I wonder how the market's going to respond to that."
Mm-hmm.
Never stops.
It never stops.
Never stops. Did you ever have, or do you have any hobbies away from the markets?
Yeah,
You just get your mind clear.
I was a pretty active ham radio operator, and we used to get in contests to see how many people we could contact over a given weekend or something like that. I used to
Hand radio operator.
Ham
amateur
radio.
amateur radio. Yes, in the
Oh,
days,
okay.
amateur radio. So I had a big antenna in the yard, and then I was able to contact people all over the world and all that sort of thing. So it kind of amused me during the thing. And then you tried to make contacts with people in faraway places with strange sounding names, and see how many of the various entities. I ended up contacting every entity that there was except for one French island in the Indian Ocean.
Really?
And North Korea, which didn't allow any amateur radio operator in their country.
Oh, interesting. I still remember those towers from being a kid, and I remember, my next door neighbor had one of those things, and the setup he had in his where his wife had kind of stuck him was amazing.
Yeah.
All this equipment, and I was like, it was amazing, very futuristic at the time.
Yeah, and now all you have to do is get on the internet. You can contact anybody in the world.
Exactly, one click.
I'll say, when did this stop becoming a thing? Because to be honest, I've never heard of this.
I didn't. Oh gosh, it still exists.
Does it?
It still exists, but it's one of those sort of it's like vinyl records.
A niche, yeah.
Yeah, it used to be really big in the 70s.
Okay.
Yeah.
Well, see, there's two types. There's the ones that do actual shortwave, the old shortwave
right,
thing.
yeah.
You do international, and you got other people that do walkie-talkies through repeaters that talk to everybody around town, and which never really interested me, talking to people around town, because I can do that anytime.
All right.
So I never. But if I were to get back now that I'm living in Addington, the only thing I could do is a walkie-talkie, because they won't let me have an antenna.
Yeah. Oh, okay.
You watch it.
Well, I had a 72-foot tower, so and the antenna on top had a 42-foot boom, so it was kind of big.
It's not exactly design friendly.
No, but the interesting thing is Florida's so flat that if you got an antenna it was 80 feet in the air. There's nothing 80 feet in the air in Florida. You've got to put it out all around the world, honest.
Oh, it's amazing.
Do we say? I've been talking to people about this, right? It's funny. Is it? Did you say Florida, or do you say a Florida?
Florida.
Florida. Okay. No, I was just laughing. A lot of old school New Yorkers. I found it funny. They say it that way. Hey, I'm going to Florida. Like,
yeah. And they did.
Like, yeah, what? Florida or Anyways, that concludes today's episode of Confessions of a Market Maker. If you enjoyed the podcast, please rate and review it for us. If you guys are interested in learning market profile, if you're interested in joining a pleasant community of traders, trade futures, equities, all of it, come join our trade room at microefutures.com. Walter, tell the listeners where they can find you and anything else you'd like them to know.
They can find me on Amazon and Apple under Walter Deemer, and they can find me on Twitter under Walter Deemer.
All right.
And they can come by Addington Place and give me some ice cream.
Yes, vanilla, and that's in Stuart, Florida.
That's in Stuart, Florida. Yes, because we're under quarantine at the moment. I can't leave the property.
Yeah, well, I'm sure if I went to Publix and I came, they were not going to let me deliver ice cream, are they?
No, but they'll let you hand it in the front door, and then they'll give it to me.
All right. Well, I'll keep you in mind when I'm passing by Stuart.
Yeah, please.
Will do. So, for the mayor of Addington, he's the gorilla.
Not quite.
I'm Paulie Walnuts. You guys use stops, though.
Thanks very much for being on the show, sir. It was an absolute honor to have a legend on the show. Thank you.
Well, as they say, I'm a legend because I lived longer than they did.
No matter how you obtain the status, it's there.
Live long enough, and you too will be a legend.